Korea on the board of directors. Rick is also the director of education, but he's also, for his day job, a mortgage broker, lender, a deal architect. He helps advise folks whether their deals make sense. By the way, if you come to Rick with a deal to get funded, either hard money or long-term 30-year, Rick loves to help analyze your deal and give you advice on whether it makes sense or not. So Rick is also holds many licenses, and he's just an all-around extremely knowledgeable guy, since he does apartment building deals, commercial deals himself, as well as lend to others on commercial deals. So tonight he's going to speak on one of his passions and knowledge areas of how to analyze a commercial deal. Rick Gurgis, thank you.
Thank you guys, glad to be here.
So, I've been in the business for 20 years. When I first got started, I've been old school banking style. Come with money, we'll come with a loan. Then I got to meet a bunch of different people from the real estate investment associations. A lot of them are outside the box. Pete Fortunato, Kurt's changed my perspective. Steve Lovy's changed my perspective. I have my own perspective. Kurt's perspective. So my perspective is evolution of finance. I think that people start in single family, go to multifamily, go to apartments, and go to commercial. Kurt, who's extremely successful, started in single family, stayed in single family, and he'll tell you single family is easy to move, and he's absolutely correct. Steve, who has a completely different perspective, goes to the stock market, which I have absolutely no interest in going into. So there's multiple different perspectives, and they're not necessarily all, they're all different, and they may or may not be correct. As a non-delegated underwriter, I'm able to underwrite for Fannie Mae, Freddie Mac, HUD, FHA, VA, Fannie Mae Commercial, Fannie Mae Residential, and a number of different agencies. I can underwrite directly to Fannie and Freddie, broker to a lender as a conduit, and underwrite speculatively to a number of different non-agencies. And I'll explain what that means as we go through. Today's topics and learning objectives are going to be entrepreneurial investment strategies, commercial mortgage basics, the liquid asset requirements that would apply, leveraging tactics, how to stay both bear and bull in your investment plans, real estate action plans, lightly touching on caps and cash-on-cash returns and ROIs, and some of the intangible qualities of success in these different ventures. 4 entrepreneurial investment strategies that we're going to talk about. BRRRR, which everyone's pretty much heard of. Buy, renovate, rent, refinance, repeat. Buy low and sell high. As obvious as it sounds, it's fundamental and necessary to touch on. Businesses. Businesses is one of the greatest development opportunities that you can get into. We'll touch on that. And notes. If anyone wants these slides, we'll be happy to circulate them. Just shoot me an email and I'll get it to you. You can take pictures too if you want. I'm not really going over flips. You can find some cherry fixing flips and make a good living doing it, but across the board right now we're at a point where there's a lot less fat on the table for making money on flips. So I don't think it's a good strategy for the average person today's market. So, some simplified commercial mortgage basics. 1 to 4 family bridge loans. So anything single family up to 4 family is all in the same box. It's all basically hard money for bridge loans. That can go up to 90% loan to cost. Loan to cost means acquisition plus rehab is the cost. So 90% of the acquisition plus rehab would be loan to cost. We offer bridge loans for apartments at 80% loan to cost. That means if you find in a vacant apartment building that may be worth a couple $1 million fixed up and operating, and you see it for $500,000 now, we can fund the renovation of a $500,000, and you can possibly benefit from that equity arbitrage opportunity. We do non-agency multifamily and investment properties up to 80%. Non-agency is the biggest growing arena. So agency is Fannie, Freddie, HUD, government entities. Non-agency means it's not any of those. It's basically private, non-depository mortgage institutions. You guys have heard of Angel Oak or Lima One. Those are non-agency lenders that are non-depository institutions. That is the dominant source of financing under $1 million. Agency over $1 million starts to split the volume with non-agency lenders at 80% LTV. So if you see 80% LTV often, that's not a coincidence. It makes it easy to explain. They're all pretty much at 80% LTV. Your bridge loans are at 90 on single family, and we'll get past that pretty quickly because this isn't really a single family or 1 to 4 family presentation. But then your apartment bridge loans are at 80% loan to cost. Your non-agency multifamily is at 80%, up to 80% LTV. And your agency multifamily are up to 80% LTV. Now there's another 500 pages of underwriting guidelines, but as far as LTVs are concerned, keep in mind that 80% is the max dominating figure. SBA and HUD commercial loans, they can go up to 85. HUD commercial loans, on average, may take a year to acquire. They're extremely cumbersome and painful to get. SBA is not hard, actually. SBA under 7 million, they're very aggressive now. The 7A products are very aggressive. Simplified liquid asset requirements. So if we're at 80% LTV, we're going to be at 20% down payment, reasonable reserves, 6 to 12 months should be a minimum expectation. Government-insured products such as HUD and SBA are closer to 15% down, reasonable reserves as well. Working on strategy 1, BRRRR, buy, renovate, rent, refinance, and repeat. You know, where's Elgin? Elgin's one of my favorite customers. When he first walked into my office, he was almost debt-free. We fixed that, didn't we, Elgin? His wife was like, who is this guy? Why is he trying to loan us so much money? Well, I think we tripled your passive income is why. I said, don't worry about it, just hold on. And he took advantage of all the leveraging opportunities that were allowed to him. And I think he went from having like, what, 4 to 10 doors to 30. You know, so in the last year, I think we've tripled or quadrupled his portfolio and his income and his net worth position. So pretty soon you'll be over $1 million, and then we'll look at consolidating that into something else too. So if you buy and rehab something and spend about $100,000, right? And then you renovate it. And this is a rough shot approach. So this $100,000 property would have an after repair value of $143,000. based on my math that I'm showing you on the screen. So if you buy and rehab a property at $100,000 and renovate it, and it's worth $143,000, your rent's $1,430 with a 1% gross rent multiplier, then you refinance it to get your down payment back and put it into permanent financing. So you're now at a point of passive income and of 715 and a 2-to-1 DSCR. In residential, we don't take into consideration expenses. So if some of you don't see that in the equation, that's because it's commonly done this way with residential. But this is an idea of the Burr method in single family. This method is also available in multifamily. You can buy, renovate, rehab, refinance, and keep your cash on hand at the same level or increase it. You don't have to continuously spend your $10,000, $20,000, $200,000. Once you accumulate it, you can put it down and pull it back out. You can put it down, pull it back out, and use it on the next transaction. And in this example, that's what happens here, and that's what the significance of this example and explanation is more than anything else, the same down payment is reused in 10 transactions and possibly even making money off the cash out depending on how well you buy. So this is an apartment building that we recently financed in Jackson, Georgia. It was listed for 1.6. I can't take credit for the fantastic negotiating job. It came to my desk with a 969 purchase and sale agreement. The financials should have been written in crayon. They were so bad to interpret, which is probably why the seller couldn't sell it to too many other people. We literally had to work with the appraiser, audit the individual units, recreate an accurate financial report, and it was a true 12 cap, and I was shocked to find that out. So in this scenario, we did a $775,000 loan for 30 years at 6.5%. Payment came out to $48.99, and that was almost a 2-to-1 DSCR, which is gold. 2-to-1 DSCR is my goal on almost everything. Elgin over here is a unicorn with his 2.5 and 3-to-1s DSCRs. He's a DSCR phenomenon, but in the real world, 2 is fantastic. 1.25 is the absolute pass-fail minimum. 1.5 should be your personal minimum. 1.75 should be your criteria for passing or accepting a deal, and 2-to-1 should be your goal, in my opinion. This analytic is different. It takes into consideration all the overhead. When we arrive at NOI, taxes and insurance are paid before you get to the bottom line, and then you just calculate the DSCR based on the principal and interest payment. So this costs someone about $194,000 to acquire $58,000 in passive income a year. I mean, that's fantastic. 30% cash on cash return. Where are my Marcus and Millichap guys? Raise your hand. What cap rates are you guys seeing in the market today?
Well, I figure you can still get decent Class C at an 8, 9 in certain areas, right? You get your core markets at 5 even now. Some older stuff, Midtown and Buckhead, we're seeing 1950s.
Okay.
Construction at 5.
So tier 3.
But tertiary markets, you can still get good 10s if you're outside of Atlanta.
Okay.
That's too far between now, but 9 is still achievable.
So in this example, if this building is valued at a 6.5 cap, that would take the value up to 1.8. Do you think that's realistic or unrealistic in Jackson, Georgia?
Santa Jackson, that well. But, how far outside of Atlanta?
No, it's not making it. Yeah. Yeah. It's a little bit closer than Georgia. Yeah.
I'd have to be awful clean to be a 6.5 that far outside of town.
Okay. So cut that number in half. That may be overly optimistic. Even if it's a $1.4 million after repair value, that leaves an opportunity for some big gains in this scenario as well. So some of your non-agency loan products will include multifamily, mixed use, retail, office, light industrial, mobile home parks, and self-storage. These are all not businesses, they're rentals, and they're investment financing. Another strategy, the business strategy, is building a business, buy a building, profit from the cash flow, sell both the business and the building. SBA finance is a great option for that. We finance Bulldogs in Buckhead. I think he's getting offers now around 6 or 7 million for that little space. The rest of the block pretty much sold out. He got into this building for $150,000. We actually pulled money out of his primary residence to acquire it, and it's a cash cow. The annual revenue is shy of $1 million. So when you're looking at valuing a business, most businesses have what's called a business multiplier. Depending on the business, a bar may be at 3.25 or 3 or 3.5. And so if the annual income is $1 million, and the bar, that bar without any assets is worth $3.25 million to $3.5 million, then you add on the business assets and then the building value. So that bar is probably worth $6.5 to $7 million as it stands now, and he was able to get it for $3 million because he worked there for a long time and the owner was ready to go. Fourth strategy, funding notes to invest at 6 to 12%. Funding, so there's attitudes all across the board about whether you should invest in the stock market or invest in notes. A lot of people would argue that the stock market's the best place to put your money. I personally like something fixed and safe, so I lean towards notes. Some people will offer 12% and want 12% returns. Some people offer 6% and want an equity stake on something venture capital. Investors often have the higher rates on hard money and lower rates with short-term equity positions on venture capital. I host the venture capital group. It meets on the third Thursday of every month at Georgia. So if you're a sweat equity guy or a contractor or someone with money sitting around that wants to put it to work, you may meet a partner that you can joint venture with or put money to work with at this meeting. There's different people with different perspectives and various opportunities. Never wire money to anyone other than the closing attorney to have a first position a secured interest on a note. So at my group, we don't do anything other than notes. So there's no SEC trade licensees, so there's no SEC trading. So you can't collect, tens of thousands or hundreds of thousands of dollars personally. It has to be for the security of notes. So, what does it mean to be both bear and bull? Glad you asked. Who's here from Anthony Char's class over the weekend? You guys all still mentally recovering like I am from that thing? Man, I feel like I've got to delete some programs to regain speed. It was brutal, wasn't it? This guy's an animal. It's like 12 hours, 4 days in a row. So a Bear investment plan is safer during a recession, and it's designed to create passive income margins. All right, so what happens to your multifamily building in a recession? Kurt, what happens to your multifamily building in a recession?
People disappear, they lose their jobs, they stop paying the rent, and you got to evict, now you got a partially empty building.
That's exactly right. Common misconception is that more people dump their houses and rent, but actually the pain goes across the board. And how do you remediate that?
Drop the rent and screen your tenants.
Exactly right. So if you have a 2-to-1 debt service coverage ratio, you have the wiggle room to come down on the rents and be and that would make you Bear. A bull investment plan is by being in the path of improvement. So if you have areas that are in the path of improvement, and we've identified quite a few in the last few months in Atlanta, and you're buying in the direction where you expect it to increase in jobs, increase in value, increase in density, that is positioning yourself to be bull. You're going to be able to take advantage of something that is a property improvement. My criteria, and it's kind of an opinion, is to have a 1.75 or higher DSCR on those acquisitions. 2, of course, is a goal. Higher than 2, of course, is always fantastic. Stay in the path of development. And, of course, you have to have long-term amortizing debt. You may do something to acquire property, but after you acquire the property, go at least to a 10-year hybrid ARM, if not a 30-year fixed. Leveraging. I meet a lot of people that have properties that are free and clear, and oftentimes they're millionaires, and they've had a lot of success, and they don't necessarily agree with me when I tell them it's not the best way to do things. There's a lot to be said for proper leveraging. In my opinion, if you have millions of dollars in real estate and no debt, you're not properly leveraged. You can't take advantage of tax-free income by borrowing against your properties. You should be leveraged to a 2-to-1 debt service coverage ratio, in my opinion, to take advantage of those opportunities. Also, you can buy 4 or 5 times the amount of real estate. If you have $1 million in free and clear property, you have the ability to buy 4 or 5 million in properly leveraged property. That we've charted it in different courses before, but that same person on your left that makes the same moves on your right, in the course of 10, 20, and 30 years, the person on your right becomes 5 to 7 times wealthier. On a 20-year cycle, I think we established that the person on the left would have a net worth of close to $1 million, while the person on the right was over $5 million. This wouldn't have the opportunity to go through that, and you guys would be so bored you'd be ready to throw stuff at them. We developed a real estate action plan. A lot of it depends on your personal attitude and how you see things. John, stand up for a second. John, who I've known for 10 years, helped me engineer it. A lot of times people will come to me and say, hey, I want to quit my day job. I want $10,000 a month in passive income. I'd like to have $1 million in the next 10 years. Your real estate action plan may be as simple as buy a $100,000 house every 6 months and make sure that it has a 2-to-1 debt service coverage ratio. It may be more complicated depending on your palette of different things. It may have a combination of different strategies from apartment, multifamily, and investment. So there's a lot of intangible qualities that really determine your success with your real estate action plan. The most important one, I think I forgot from the list, and I'm going to blame Anthony Chara for the brain damage he gave me over the last 4 days. And I would say that'd be tolerance to risk. Your tolerance to risk is probably the single most defining characteristic in your investment strategy. You know, I get calls from people sometimes that have absolutely no tolerance to risk, and they want to know what I suggest that they do. And my answer is whatever you want, because if you you know, drop dead because of some stress that you got from doing a project, you did no one any favors. Now, next is internal fortitude, staying to the discipline of the plan that's set into place, depth of resolve, commitment, your problem-solving abilities, perseverance, your experience, health and wellness, communication, and general skills. Now, all this may seem overly simplistic and not conversation-worthy, but it is this more than anything else that really dictates the path that you go on. You have to believe in your path that you go on. So I personally won't ever own more than 15 things. When I can't remember where a house I own is, the wheels start to fall off the truck. You know, I don't know how Kurt does it. He's just a smarter, stronger man than I am. You know, a lot of people say you have managers and you have systems in place, but and you could say whatever you wanted to me about it. You're not going to get me past that. You know, I would rather go into larger ticket items with fewer quantity than go into a number of single family or 1 to 4 family projects. And that's my personal disposition. It's a psychological disorder, but that's who I am. So it doesn't matter how brilliant you bring a proposal to me with 100 houses involved. I'm not doing it. You know, I just don't want to. You want to say something to that, Kurt? Okay. Services, I've never done this presentation before, so I have no idea how long it takes. If after the presentation you guys have questions, scenarios, I'm happy to take any of them. I think we're running out of slides. So, services we offer is consulting, helping people develop real estate action plans, education at Georgia RIA. You know, we haven't totally decided which classes we're going to offer related to this, but it'll be available on the website at some point next week. Residential mortgages, commercial mortgages, private note selling. So we do Fannie, Freddie loans. Elgin's last loan was at 3.875. He's pretty happy about that. Hard money loans, 12%. So we run the gambit. But if you're buying a property that needs $100,000 in rehab, and you're acquiring it for $100,000, or a $500,000 apartment, and you need $500,000 in rehab, a hard money loan is by far the best product. It's going to fund your rehab, and it's a short-term interest-only loan. So even if it's at 1% a month as a payment, it's going to literally save you the amount of rehab. Questions?
Full bear, Rick. So in the bull strategy, find the path of progress, since you're a lender, underwriter, doing deals yourself, where's the path of progress?
It's all over Atlanta. A lot of people are moving to Atlanta. I like Union City. I like Marietta. I like going west from where CSX sold all their tracks. You know, I don't know how accurate the rumors are about the 21 multi-use facilities going in on that side. The UPS facility on the south side, can't go wrong there. Can't go wrong where the new Avalon is going up near Sugar Hill, the Amazon distribution facility in Stone Mountain. The only area in Atlanta I might be a little squeamish about is parts of DeKalb County. But Atlanta, we're fortunate here. We've seen 6 or 7% average appreciation in the last couple of years, which is off the chart and 2% higher than the national average. You know, we're picking up a lot of population from the West Coast and the Midwest and the Northeast. And I think people are trying to figure out that Florida kind of sucks too. They're coming up here as well. So anywhere in Atlanta, I feel pretty comfortable with. Fannie Mae, Freddie Mac, HUD, they've already developed all the criteria. They call it Tier 1, Tier 2, and Tier 3. Basically, any area with over a 40,000 population in that city that you're in is decent for apartments, and any area that has jobs moving in, which is, you know, your criteria, and you teach people that all the time, is great for single family, there's just opportunity everywhere in the 13-county metro Atlanta area.
On your real estate action plans, do you have a step sheet that like you can email in and say, this is what I want to speak to you about, and it's like a consult, or how do you handle that?
It's probably going to be $500 or something. It takes about 5 hours, and most Georgia RIA members are at 100 an hour. So if you're a Georgia RIA member, it's 5 hours.
There was an article in the Sunday paper that touted Clayton County is the best place to buy a house. What's your thoughts on, did you read that article by any chance?
I wouldn't know if I read it or not after this last 4 days. And I don't present myself to be a market expert, so I have no idea. You know, you guys from Marcus and Millichap want to tell us about something? We'd love to hear something intelligent. Something intelligent.
I don't know if I can help you out there.
Give this guy a microphone and have him come to the front.
You're all going around.
We're serious. Come on up here.
Well, we're wrapping up. If anybody has any multi-family specific questions, I'm happy to help you out.
He's going to give you a mic.
All right. Yeah, so hi, Dan McBurney. I'm with Marcus and Millichap. Maybe some of you have heard of us. We're the largest private client investment advisory firm in the country, but we only do private client investment advisory, so you don't see our signs all around town, unlike the CBREs or Cushman or Colliers. Yeah, so I specialize in multifamily investment sales, and it's a great time. I mean, it's sunshine and blue skies, and the outlook's very strong for Atlanta, at least. Other property types might be getting a bit frothy, as the saying goes, but multifamily is, you know, it's still strong, and the outlook is very strong. Job growth is off the charts in Atlanta, and I got my start 30 years ago, like many of you, just buying single family, then duplex, then triplex, then quadplex, then 6-unit, 12-unit, and ended up getting into the larger multifamily properties. Now I strictly do investment sales, but it's a great place to be, and you're going about it the right way. So if anybody has any specific multifamily related questions, I'm happy to touch on them, or I'll stick around a little bit afterwards. Go ahead.
What's the right size for a smaller investor to start in multifamily?
I won't say there is a right size, but I will say that if you can stay in the capital markets space, right? So minimum loan amount in the capital market space is going to be $1 million. So if you're typically buying at a 75% LTV, then you want your purchase price to be a minimum of $1.35 million. That is going to give you a lot more in the way of financing options, better money, right? More cost-effective money, because in the capital market space, those financing rates are tied to the 10-year treasury, as some of you may know, right? Not to the short-term lending rates that the Fed sets. So rates right now, we're in an inverted yield curve situation right now. So long-term rates are actually lower than short-term rates. Now, some would say that that's not great news, because then that is oftentimes a leading indicator of a coming recession, but I think everybody knows that we're bound for some type of economic slowdown, right? We're 9 years into a recovery, and the typical recessionary cycles or economic downturns are every 8 to 10 years. But don't let that dissuade you, because multifamily in Atlanta is going to be an outlier.
I personally don't agree with that.
No?
I think that the doomsday predictor started in 2014, predicting the first one in 2016. 2015, they predicted one in 2017.
Yeah, right.
2017, they're predicting one this year. Yet the sky hasn't fallen. I think we have a lot of control over the future of the world. The last crash that we had, I think we managed our properties like a bunch of banshees. You know, it was absolutely ridiculous what happened in the bond market and the financing side of things. And if you would have told me in 2005 that they would have passed a series of laws that required every loan officer to educate every consumer, I would have fell out of my chair laughing so hard. But then I read the Dodd-Frank Act, and it actually happened. We spend an hour educating almost everyone that comes across our office, and I don't think so when someone says the market's softening, of course it's not going to sustain itself at 6 or 7%. It needs to come down to a 2 or 3% growth, and that's where I'd like to see it stay. But I don't see us seeing anything negative as far as growth is concerned. Would you expect to see a negative growth in the next 2 or 3 years?
Well, again, you have to look at the property type in the specific area, but I wouldn't think that in multifamily. Absolutely not. Absolutely not. But just to specifically answer your question, then just to close that out. So if you don't have enough equity capital to deploy to stay above that 1.35 million, then stay at 4 families or less, because then you're in the conforming space, right? So then you're in the conventional loan space, and it's a lot easier to get financing. So always think, right? You make your money when you buy, not when you sell. But then you also want to buy something that someone can then easily buy, right? So if they're not in the capital markets realm, then you want to be 4 families or less so that they can go conforming. Is that all right? Yep.
Question for you on multifamilies, buying multifamilies today with potentially a slowdown coming. C-class properties versus B-class properties. Can you compare and contrast and give an idea of what to expect in a downturn with each of those types of properties?
Yeah, so I personally, I would say C-class, but obviously it's all specific to area, submarkets, hyper submarkets, right? But let me say this, there is a shortage in workforce housing. So workforce housing is going to primarily be your C space, right? That C tranche of the lower third of any market's rent range, right? High to low, that lower third. So that lower socioeconomic tenant base is where the money's going to be made, I think. I think that's where the demand is going to be consistent, right? They're not building any C-class. You can't do that. They're building tons of A-class, so that's putting a lot of pressure even on B. Yeah, I mean, we do a lot in that C-class space. Personally, we do. And, I mean, it obviously comes down to the actual opportunity, right? There are B-class opportunities that are better than C-class opportunities, but the outlook for the rent growth is stronger in C-class. Yep.
So where's the best place, or what's the good strategy for finding the 1.35 million properties that have the 2-to-1 debt service coverage ratio? How do you go about saying, okay, these are 3 or 4 potential properties and evaluating that?
Well, so there's geographic considerations, right? So there are certain areas maybe in Atlanta that I like that I'm somewhat bullish on. But for me, a lot of it came down to convenience, right? I want to own in a market that I know like the back of my hand, right? That's where you want to feel comfortable buying. And then to one of Rick's earlier points, it's risk tolerance. Okay, so if you want to go, you can find nice C-class in Midtown, right? 30s, 40s, 50s, 60s built, maybe not so much 60s, but 30s, 40s, 50s brick construction, but that's going to trade at a 5 cap right now, right? Who wants a 5 cap? So you go out to the tertiary markets, go down to Stockbridge, right? Those types of areas that are growing because of what's happening down around the airport. And you can still get a nice, clean 8.5, 9 cap down there and just ride that, you know, rent growth. In an area where you live, maybe, right, a Stockbridge, but maybe like Stockbridge near where you live. Marietta.
So you lean towards finding something that needs a little bit more management and trying to wiggle the margin up a bit.
Yeah, I mean, you know, if you do self-management, there's lots of opportunities. I love, you know, helping owners that self-manage their property but haven't been doing a good job doing it. I love to, you know, help them sell their property, and those are the opportunities you look for, right? That needle in the haystack, right? That diamond in the rough where a guy just doesn't know what he's doing and he's run it into the ground maybe, or at least he's not maximizing the efficiency through his operations. Yeah, those are the ones where that's your upside.
How about renovating abandoned buildings or adaptive reuse? Have you seen success in those areas?
Well, I'd say if you get into that, don't make that one of your first or second or third or fourth or fifth, right? Know what you're doing if you're going to get into that, because you can burn through a lot of money quick. Gentleman back here's been...
What's, from recent sales standpoint, what are the lowest cap rates you've seen on Class C sales in the last 6 months?
I've seen sub-5s.
Cobb County area.
Oh, Cobb, sorry. So yeah, I mean, I have 6, maybe 5.5s. Yeah, I mean, depends. Obviously, that's a big geographic area, so there's going to be pockets of it. But certainly near where I live, in Midtown, I'm seeing sub-5 cap rates on Class C. Yep. Yeah, someone else was, but go ahead. Well, either way, the young lady here.
I haven't invested in multifamily before, but so I'd like to know what does C-class building look like at 1.35 million? How many units does it have? What does it look like? What are we talking about?
Well, I have to say what it looks like, right? A couple of doors, windows, roof, yeah. But no, so and this is something that a lot of people, everybody's got their take even on, but think of a rent range in a given hypermarket or submarket, geographic area. So if there's a 2-bedroom, 2-bath, whatever, the cheapest one that you can get is $800. And then in Midtown, a typical nice Class A 2-bedroom, 2-bath is going to be $2,500, right? So somewhere between 800 and 25, cut that up into thirds. Well, so the bottom third tranche of that rent range is going to be C-class. That middle tier of that rent range is going to be B-class, and then up in that upper realm is going to be your A. So your C are going to be older, right? They're going to have deferred maintenance. They're not going to have amenities, right? No elevators. Yeah, so it's a 4th floor walk-up type situation. Yeah, that's probably going to be your C-class. So a lot has to do with condition. Amenities, of course, right? The A classes have the pools and the club rooms and all the rest of it, and then condition. Yep.
What's the most important way that you see creative on real estate being done to actually acquire apartment buildings?
Yeah.
You see oftentimes.
That's a CLTV question, if you're wondering. He's wondering if he can do a 100% finance with the seller carryback second.
I mean, look, when I got, it's a great question, because, you know, when I got into it, right, and you go to the seminars, it's like, hey, no money down, right? Yeah. So creativity it's a way to get into trouble if you're not careful, right? Over leveraged like I was at one time. So, I mean, obviously, Rick, I'm sure, can shed more light on how to be creative with the seller financing. And
yeah.
Look, I've walked from closing tables with cash in my pocket, right? I don't know that you can do that anymore, but I've closed on properties and walked with cash in my pocket the day of closing.
it's not a good conversation. They want you to put 20% skin in the game. Now, on a SBA loan, you can have a 10% seller carryback second on most of your non-agency stuff and your agency stuff. I don't see any seller carryback seconds happening.
You said the SBA loan is a lot easier to get nowadays?
SBA is a great program. The LTVs are very high, and it's a business loan. So you've got to have the disposable cash in your financials to afford the new debt. It's always better to be acquiring a business that complements your business and the building that you're already in, and or a partner buyout and things of that nature. But it's one of the most aggressive programs. The SBA developed it to stimulate the economy and growth. Dan, we're a difficult group, so if you hear someone push back a little bit, it's just because they like you. And you stay up as long as you want. We're glad to have you.
That 1.35 that you said is the optimal price to purchase that, is that what it has to be valued at when you buy it, or if you work out and say you get it for $800, you have to put so much into your TV to 1.3?
Right, so just to clarify, that would be not necessarily optimal, but the minimum, right? So that if you're buying at a 75% LTV and the purchase price happens to be 1.35, then you can get a loan that is a minimum of $1 million. So when you're borrowing in what we call the capital markets space, the minimum that they will lend is $1 million. So then you got to buy something that's 1.35 or greater. So it can be 2, it can be 3 or $4 million. Just if you try to buy anything less than 1.35 million, you won't be able to get capital markets financing. So then you're stuck going to a bank, which the rates aren't great right now, harder to get, got to be in state, right? Or if it's 5 units and it's $900,000, that's a tough one to finance. Tougher, but that's more of a Rick question.
Yeah, his experience is a little different than mine. They're a large agency and they have their products. I have a little bit more flexibility. We do loans down to $200,000 on apartment buildings, and there's no limit on our hard money rehab stuff. So depending on your rate tolerance, there's products all over the spectrum. So there's products at 6 to 7.5 that are long-term holds on the under $1 million. There's your renovation loans are from 8 to 10 on the apartment side. So the apartment loans have a 2% lower interest hard money rate. There's all kinds of products. They run the gambit.
Well, that's a great point. So, and to your question then, or to your scenario, yeah, if you can buy something at $800,000 knowing that you're going to get a bridge loan, so it's going to be a little expensive for a while, but you're going to spend the next 1 to 2 years fixing it up and stabilizing it such that it'll be worth more than 1.35, then that buyer who buys from you, right, knows that he can go out and get capital markets financing if it's more than 5 units or more. 4 units or less, you're fine because that's Fannie Freddie conforming conventional loan. So that's boilerplate stuff. And he's thinking more about, okay, the non-traditional financing, or as I think, traditional cost-effective financing.
If the cap rates are running 5 to 7-ish, and then outliers up to 9, how are you seeing 2% or 2.0 debt coverage ratios at those prices?
Well, you can always take your debt coverage ratio to 2 to 1 by paying down the loan to arrive at that.
Yeah, sure, but then you're dealing with the same, I own 4 houses free and clear. You're advocating leverage to accumulate properties.
So give me a
It's not going to get that 2.0 with the current cap rate.
So it's a goal. 2.0 2 to 1's a goal, but you have to give me a specific scenario with actual numbers for me to walk through it.
Okay.
If you have a scenario, I'm ready.
No, I don't have one handy, but I'm just.
You could make
these numbers.
So a $1 million building at a 6.5 cap is going to be $65,000 a year NOI, right? Mm-hmm. So that's going to leave you with $32,500 for your PITI payment. So $32,500, you're going to be down to Kurt, what do you have to finance at 32.5 to 4.5%? Yeah, we can't do that fast, all right? So, but that would put you at around at 4.5. That would put you around 65 LTV, as opposed to 80 or 75 when the cap rates go that low. I personally don't have an appetite for anything under 10. So I try to create the situations by either improving distressed properties or abandoned properties or adaptive reuse, because I don't like to wiggle through tiny margins. That's not my space. If it doesn't have a lot of meat and fat on the bone, I don't want to play. I want to be comfortable and be able to fumble through and make money despite myself.
Well, your example and your slide down in Jackson was an example.
Yeah, that was a recently closed transaction. Steve?
How did that find the deal in Jackson? Was it LoopNet? Was it a broker?
It was on LoopNet. It was listed for like a year. It's probably still on LoopNet. The agent's Deb Harris. I'm sure she didn't update it. So you could probably Google it right now and see that it's listed for $1.6 million, and then go to the courthouse records and see that it's sold for $969. But the seller is a retired attorney, and he's not feeling so well. So take the most difficult person you ever met times 10 and communicate with this guy. And then take his financials, which are all commingled with God knows what, and then missing portions of it. I mean, his T12 came in a puzzle. So that was one of the biggest challenges with this guy, but we were able to force feed it on the appraiser and then make him do a door audit and then get his report and have everyone sign off on it back in a backwards way system to arrive at accurate financials that were physically audited by an appraiser, which was the bank's rep in the transaction. So we made it work by sheer will, and the buyer knew it was a good deal. The seller was ready to go. So those are the two most important pieces in assembling a transaction. Rick?
What impact for investors could be seen from opportunities?
Who's that question for?
There is a lot of interest brewing now in opportunity zones, or to put money into opportunity zones. Institutions are putting together funds specifically to invest in opportunity zones. So, you know, depending on the size of the asset, that could be the realm of a lot of competition and a lot of bigger players. But just from what little I'm learning about it, there's a lot of interest and a lot of money chasing it. Yeah. So I would look into it. Yeah. I mean, if there's that much money and interest in it, then there must be something good there.
Transition from basically single family or small multifamily to high level commercial. The terminology is so different. Do you know of any resources for somebody to go out? Because a lot of it is you don't know what you don't know in terms of terminology. The concept is the same.
Anthony Chara has an apartment mentoring class that'll leave your brain completely fried in a 4-day boot camp, and you'll leave there a much more tired person than before you started.
Of course, there's always just Google multifamily investing, right, and read everything you can read.
Doesn't the Mortgage Bankers Association still have their little glossary of mortgage terms?
So there's literally a handful of us, including me, that spent 4 days in Anthony Chara's boot camp that got out on Sunday, and I can tell you, as someone who's been in the industry for 20 years, that you're not going to get a proper education in passing.
What should you advise beginning apartment investors to look at tertiary market, secondary market,
I personally like areas with populations from 40,000 to 70,000. because you can sometimes polish it up and take something that's a true 12 like this one was and make some money. You have so many options when it's cash flowing and you have instant equity. You can acquire a handful of them and retire on your passive income and still benefit from the appreciation, or sell them relatively soon. Those are the areas I personally care for. The in-town ones, and I've been looking for a while, are just too overpriced. You know, and a lot of times the prices are based on these cooked pro formas, and you've really got to take a pencil to them and start redlining where they're cooked. You know, it's the worst thing since the hotel business.
I would agree with that. Tertiary markets, if you can find a nice clean 9 or 10 cap in a tertiary market, that's where you're going to make your money. Why buy a 5 cap in Midtown? You know, right now, I mean, the rents are going to be flat there anyway. You know, you're not going to get appreciation or be able to force the appreciation probably, unless it's a real dog. And there aren't too many dogs left in Midtown for you to be able to force the appreciation through rehab.
A couple of questions for you. If somebody had a portfolio of typical single-family homes that people in Georgia would have, and they have an option of selling it to maximize their gain, or is it easier to sell it based on cap? What kind of caps are single-family homes selling at, or just sell it for owner-occupied?
Right. So, I guess there's two things then built into that question, right? So it's sell the portfolio individually, right, on a fair market value basis, right, or sell it as a portfolio, which I typically recommend people to do. If you got 20 houses, right, you can always say, oh, sell them off individually, retail, right, to an end user, owner, occupant. You make a little more, you make a slight premium, but then you got lease expiration issues and the tenants there, and are you going to really show it to a person who may move into it to get that top dollar retail price? Or you sell it as a package, then you can 1031 all the money, right, because you're selling them all at the same time. That's, in my opinion, the way to go. I've sold a lot of single family home portfolios and looked at it both ways.
The other question was, a couple of years ago, I looked at some REITs, and you could actually buy the REIT for about 60 to 65% of the value of the real estate itself. Are you aware of any REITs that have apartment complexes in Metro Atlanta that you could buy the REIT, sell off the assets, and keep the cash flow?
Well, so you say a couple years ago, or maybe 10 years ago, REITs were trading at that much of a discount. I don't know too many REITs that are trading at any discounts now, right? But I mean, I guess if it's mismanaged, or if you'd have to look at the underlying assets. However, there would be a single-family home portfolio that someone may be mismanaging it, not in a REIT necessarily, but in their own little, you know, personal REIT, if you will. So yeah, I mean, if that's where you're looking. You're looking for those mismanaged opportunities, right?
Be careful with your bundles of houses. They have to be within a mile radius to go Fannie, within a 3-mile radius to go Freddie, and then under $1 million, it's going to have to go non-agency, and that rate's going to be at least 6 1/4.
Right in the back.
Do you have any bundles for sale?
Sorry?
I said, do you have any bundles of houses for sale?
Personally, at the moment, no, I do not. Nothing right now, but maybe there's some folks here in the room that might want to unload some of their single-family as a portfolio and roll it up into a multifamily.
We'll make you an offer you can't refuse later, Frank.
Right there in the corner.
Do you have any apartment complexes for sale?
Well, that's a great question. So I'll ask a question of the audience here. Who would want to go to Thomaston for an 11 cap? That's 40 units-ish.
Where did you say this?
Well, somewhere in the Thomaston area, let's just say. South Central. But no, it's a good 11 cap. There's a gentleman here who's about to take one to market, so you'll want to see that handsome young man in the middle there at the end.
We have one in Marietta, too.
All right. Well, there's lots of them around. I don't know too many 11 caps in Marietta, but if there's an 11 cap in Marietta, you better jump on it. And don't be telling everybody. Any last? See me afterwards. I'll give you a card.
And you'll see us afterwards at the Rosencrown Irish Pub on Powers Ferry Road. So we're going to leave it open for questions for one. Go ahead.
Would we email the slides to Gina address?
Did you guys get cards? Yeah.
Could you elaborate on your the business strategy?
On my personal business strategy?
No, you mentioned business investment strategy, where you buy the property, develop the business, and sell off.
Yeah. What business are you in?
Restaurant.
So you would do the business that you're in. Are you the principal of a restaurant? You own your own restaurant?
Yes.
Okay. So you would get you would try to get an SBA loan to buy the building, and with SBA you can get multiple 7A loans and do owner financing in combination with it. The last SBA business loan I had literally came to the table with 5%. So you would need to have someone review your financials. It would take 3 years of financials to get qualified to purchase it. They'd be monthly reviewed and annually summarized. You may want to look at getting into a lease purchase, and then once you're in the building, buying it. That's an easier way to roll with acquiring buildings and less risk from the SBA perspective. But that's a long and complex question and would take a lot more analytics to give it the answers it deserves.
Okay. So what if you already have the building, already have the rest of the business started? How would you transition from that to an SBA?
So when you say you have the building, you own it?
You already purchased the building. You
Okay.
already started the business.
Is it free and clear? Do you have a note?
There is a note, owner finance note.
Okay, that's a great scenario. So the SBA loan would be a roughly 85% loan to value on the value of the business, the value of the building. And then you could borrow additional money on a 7A at 70% of the value of the business. And then you might be able to get 65% of the assets. So you may or may not necessarily even need to come out of pocket in that scenario, especially if the building's appreciated since you've been there. Yes, sir. There are no veteran programs available for you, Frank. They specifically say not available for Frank. VA is 100% financing on owner-occupied only. It's got to be full doc per the Dodd-Frank Act. So that's going to be 2 years tax returns or income statements. But you can go up to your eligibility on your DD 214 and qualify for 100% financing or your award letter. Is that what you want to hear?
Well, it's not more commercial.
No, not really, that I'm aware of. Do you know of anything that's favored veterans?
Commercial space, no, not that I'm aware of, no.
Yes, ma'am.
I was wondering if you could talk a little bit more about commercial and what about malls,
Sure. So there's several buckets of financing types, okay? The first bucket is the loosest one, the private money, which ranges 8 to 10%, has the lowest loan to values, and will do anything that makes sense. The second bucket is your non-agency depository institutions. On the commercial side, say between 200 to $1 million. The LTVs are lower; they're around 65 to 70% loan to value. If it's a business that occupies more than 51% of the space, then it's your profit and loss statement that's going to be required and scrutinized, as opposed to an investment property where you're not running a business, it's looking at, rent rolls and NOIs. So back to business, they're going to look at your cash flow and see that your debt service coverage well based on your profits and losses. Your SBA loans go up to 7-8 million, and then and your unsecured 7A loans can go up to $500,000.
I understand that the financing part of it, but what about the actual people who are buying commercial property versus multifamily?
Is retail runs hot, is office hotter? Yeah.
So in Atlanta, there's a demand for large office space, but not small office space. So the big companies that like the bigger office spaces are having trouble finding the larger office spaces, but the small BC class office spaces are readily available, and I kind of like downzoning them actually for adaptive use into residential. But I don't really like office space as a culture. We're moving more towards a virtual world, and fewer people are going to offices, and they're telecommuting. And so it's a lot more big company business. I don't really care for the office space realm myself. Retail makes sense in a number of different arenas. I am not a market expert. So I know certain things and sample from my personal experiences, but business development is such a complicated realm. It's everyone's industry, and in each one on what they thrive in personally in business, and then developing it into a brick and mortar and business model is a longer story. Okay. I mean, I'd love to see a triple net lease over at least where you're the landlord responsible for the other items, but I still am not a big fan of smaller offices. They're just hard to, in my opinion, hard to manage and show a lot of profitability on. The trend for that is the WeWork space, with the smaller spaces and the higher density office things. I just happen to know because I've looked into it, not because I'm an authority on it. Those companies are franchises, and they oftentimes will buy your build out and then lease your space, and you can get $22 a square foot by leasing to WeWorks. But again, that's not anything I encourage people to do. I encourage people to do the businesses that they are good at, and then develop brick and mortar. I encourage people to get into BC apartment buildings, because that seems to be the safest thing in both Bear and Bull, with ability for upward mobility and safety on the bottom.
Rick, if I could touch on that as well.
Yes, please.
So obviously, to his point, it's what you're comfortable with, right, the property type, but specifically your question and as it relates to other property types that might be attractive at the moment, let them to be clear, first of all. So multifamily is commercial, right? You got your single family residential and your 1 to 4 family, and then you've got commercial, everything else, retail, office, industrial, you name it, right? So multifamily just happens to be a type. If you like multifamily, and if you understand the concept behind multifamily, then and if you're thinking, well, what other property type might I want to try, then it would be the smaller flex office warehouse, because they operate a lot like multifamily, right? You've got a little office warehouse, 1,500 square foot bays, 40 tenants, and often the leases are 1 year to 2 year leases. So that really runs itself like a multifamily 40-unit apartment building, except the people are there during the day instead of at night, right? Like it's a flip-flop. And then if it isn't, say, the smaller flex office warehouse type property, think about self-storage. It's not glamorous, but that's where the money is sometimes, right? Where there isn't glamour, then there's money. So if you like multifamily, I would say, yeah, stay away from retail, especially the smaller, retail strip centers, there's the risk there if you've only got 4 or 5 tenants and one of them goes out on you. But if it's self-storage, if it's, multi-tenant, and when I say multi-tenant flex office warehouse, I'm meaning 20 tenants and up, then that's a lot like multifamily, and you might find some comfort there or come across a good deal.
I get emails all the time on like Dollar Generals and stuff, and I see some of them at 6.5 cap, some of them are at 7.3. How do you evaluate, okay, what makes this one a better buy, vice this one? You just go off the cap rate, or what are the decision makers?
So I happen to see a lot of Dollar Generals for sale too, strangely enough. A lot of times it happens when there's a CVS that opened right across the street from them, and they have a lease that's about to come up due, and is next to a hair salon. So the term of the lease is really important. If the lease is 20 years long, that's fantastic. Unless it's 20 years long with a 2-month option for buying out of the 20 years, then it's terrible, So it depends on the long term of the lease, and then it also happens on what's happened in the direct area. If 3 more convenience stores recently opened up and the apartments are closing down, then it's a horrible buy. If there's jobs, apartments, and no competition, long-term leases, it's a great buy. So it depends specifically on what's happening around there.
I've got experience in that arena of that conversion space.
So what's being converted from what to what that you've seen?
So industrial zones, industrial spaces,
Mm-hmm.
and they're being
Became offices?
multi-use.
Did that happen around the time of the legalization of marijuana in California? Because they would need offices to manage all their pot growth. Okay.
We ended up having quite a few people wanting to do it in those spaces.
Mm-hmm.
We can have our little grow areas in the back, or our stations in the back.
Yeah.
And the front office would be the distribution center.
Yeah.
Didn't happen, but they tried.
Okay.
Yeah.
So that-
A lot of office buildings, even 2-story, multi-tenant office buildings, those office spaces selling as condos. People were owning their office space.
Okay, so they stayed. Okay, so it was an office building that just sold the units.
Yeah.
Okay.
And any of that kind of converting going on here?
Yeah, that's going to happen everywhere. It's just an office selling off their units, going condo.
So, okay.
Yeah, it's just the ownership selling individual units.
Yeah, well, it turns out if you sell, you gotta sell the whole thing. You can't just,
Most of the adaptive reuse here are the gigantic malls that have gone bankrupt.
Okay.
People take them for their restaurants and movie theaters and churches.
Yes.
So
She's not. I don't think she's talking about adaptive reuse. I think she's talking about an office building selling the units.
We're just taking parcel and we're using it.
Well, legally, you could condo anything, right? So if it's a multi-tenant space and those spaces are leased, you could then fee simple those individual spaces. At the tail end of the last residential cycle, that was a big play. It's an arbitrage play where you take, okay, I'm going to buy this 100-unit apartment building, and I know I can buy them at $80,000 a unit based on the income stream and current caps. But hey, all I got to do is legally change the structure, fee simple each of individual apartment, condo it, and I can sell them for $150 a pop because the condo market's going nuts right now in 03, 04, 05. So that was a play back then, and I guess you could almost do it with any property type, right? You could take a multi-tenant strip retail and condo that. But it's all just dependent upon market fundamentals and the dynamics of the market at that time, if that's a sensible strategy. But we're not seeing that now. We're not seeing that happen, even in the residential space, because the condo market hasn't overheated to the point. If anything, because then what was happening is a lot of those busted. So we had reverse condo conversions, right, where you had to take a partially converted condominium that maybe they didn't sell all the units after the crash, and you had to convert it back into an apartment building because the values dropped out the bottom fell out of the values. So it really just depends on the timing of the market, the property type, cost of ownership. Is it cheaper to rent than buy, or better to own than rent? kind of thing, and those dynamics will play out, and then people will do it because there's money to be made there. But we're not seeing that right now.
Yep. 2 more questions, and I'll let someone buy us a scotch. Go ahead.
Where are cap rates going on self-storage, and what kind of opportunities are out there now?
I don't profess to be a self-storage expert. We do have at Marcus and Millichap, we're all kind of siloed in teams, so we just specialize in multifamily, or we have a gentleman here that does single-tenant net lease retail. We do have one of the best teams, the strongest teams in Georgia and the Carolinas at Marcus and Millichap that does self-storage. So I have heard, like everywhere else, cap rates are getting, plummeting. I mean, I say plummeting, that's an extreme, but they've come down a lot because that particular property type has become more attractive. So it's attracted more dollars, which has put downward pressure on caps. So they're probably in the fives. You wouldn't think it, but there's self-storage properties with cap rates below 5. Newer.
Yeah, so my personal opinion on cap rates, and in California they're at 1%, I think that's ridiculous, is that you can't go below 5.5 and then really expect to finance it, unless you're playing with the yen and you've got futures and exchange rate opportunities. For the typical consumer, anything below 5.5 is just absurd. And whatever's happening in the market, you just have to leave it alone. But again, that's another thing that's great in the tertiary markets, that you'll find better deals on, and maybe things in the double digits.
With the levels of debt that have been added to the system, to quantitative easing, 1, 2, 3, count however high it's gonna go, how do you see this next potential slowdown, whenever you think it comes, being different from 2008?
I mean, I'd love to take that.
Well, yeah, I mean, you didn't think there was, I guess, maybe I misunderstood you, but if there wasn't going to be much of a slowdown, it will never, well, let's hope, let's pray, right, that it'll never be as bad as it was in 2008, because that was the second worst in history, right? That was the Great Recession, only, compared to the Depression, right? I mean, of the 1930s. So there is an economic slowdown every 8 to 10 years. Just look back through, the collapse of the savings loan industry, interest rates when they were, before Reagan deregulated banking, when they were 15, 16, 17%. So you just go back through history, and every 7 to 10 years there is a cyclical economic slowdown. But the one in 08 was the worst that we'd had since the 1930s. And with the stopgaps that have been put in place and things like Dodd-Frank and getting rid of some of in that case, the financial products that caused that, right? Mortgage-backed securities and whatnot. Let's hope that it'll never be that bad again.
And just to provide a little more context, I mean, this is kind of a larger global question, in the sense that, like, the level of debt that are in the system significantly higher. You think about how much just, you take the S&P as a measure, how much this increase in 2008, we're talking about a lot more money, a lot more growth, a lot more debt. So you guys see that playing out in the real estate market differently than it did in 2008?
I mean, it's 2019. We're overdue for our crash. 2008 was 11 years ago. I think we have complete control over the future. The stock market would be the first thing you would watch, because that's 300% over what it's been 5 years ago. But they're still moving up, and things are being well ran, and I don't think we're going to have a stock market crash. I think things are going to continue to go up for the foreseeable future, at least for the next 3 years. So in 2008, we had the IT crash, and then we had the IT crash in 2003 or 2002. We had Silicon Valley started to take a bath around 2005, and then we crashed in 2008. Everyone in Atlanta was juicing appraisals, pulling cash out, doing cash out purchases, and it was just ridiculous. So, and that we saw happening and forming over 3 years. So it's not like, you get pushed off a cliff in 2 seconds. You watch it form slowly over 3 years. And there's no evidence of any of that happening right now. Sure, the value of the market's overvalued. It's 300% of what it was 5 years ago, but you don't see any real corrective measures having in the stocks. Sure, California's at a 1 cap, And I don't understand why anyone would buy it there, except for Chinese investors with yens, but you don't see any corrections happening there. And when you do see it happen, you see it form slowly over years. So you're not going to wake up one morning and your dollar is going to be worth 10 cents. It's going to be a slow-forming train crash that you're going to have months and months and months to react to, as it was in 2008. I started going virtual in 2006. You're welcome.
No, I disagree with you, because during that time, people walked away from their houses too. It was like,
Right.
that's how they walk away.
Exactly. So why do you disagree with me?
It's not that I agree with you.
Oh, okay, I misheard you. But did anyone else hear that? I was like, I gotta send Anthony Charr a letter. I don't know what was in that water.
So one more quick crazy question. Do you see the Bitcoin market moving into real estate?
I'm not a Bitcoin fan or authority, so I have no idea. I am a fan of Johnny Walker Black Label, though. If anyone wants to buy me one, they'll have an opportunity to do so at Rosencrown in about 10 minutes. Thank you. Hey man, thanks for coming out. Good sport. Glad you guys made it. Good to see you again. Let me turn this off.